But our second question via email came in from Mike E. And Mike E wanted to know, when I go into the married puts and click the search tab, a list shows up. Is this the list of married puts that you and Ernie are invested in? He says, is there some other way to follow the married puts and subsequent covered calls that Ernie or yourself are invested in? Okay, well, Mike, it's an easy answer to that question. But to do so, I need to go ahead and switch my screens. I guess it would help if I got out of that first, right? There we go. Okay. Fantastic. So we're just going to navigate over to PowerOptions. There we go. Great. Okay, so what we're talking about here is in the married put positions. As I mentioned in the beginning of the presentation, married put approach is the limited risk approach that we prefer to use with the bulk of our core holdings in our portfolio. Depending on where you are, this might be 40 to 50% of your total portfolio for protection on core holding positions. Or if you're older, you want to protect the core holdings more, it might represent 70 to 80% of your portfolio, and using the other portfolios for some of those other strategies as we just talked about. Our approach is based on our course, the Blueprint, which discusses the proper structure to follow the 3 core principles of really any trading, but really the radioactive trading concepts, and the 12 different income methods we use off that limited risk strategy to lower the initial at risk, generate income, enhance returns, and of course, potentially bulletproof the trade where we have no risk to the downside and still insurance in place. As with any strategy on PowerOptions, when you go to the Married Put tab and you go into search, you're going to see a list of trades based on our default criteria. If you scroll below that criteria, you can see the name and you can toggle between other searches that are there, and you'll see a description. This default search that Mike was referring to that initially comes up is the radioactive sorted by earnings per share growth. This is based on the education in the Blueprint manual, the type of stocks we want to look for, and keeping certain things such as the risk to a controlled level, volatility on the stocks, we want to see some movement, and the time frame that we look for as well. These are not the trades that Ernie and I are invested in. Okay, this is not a table that's showing everything Ernie and I are invested in right now. This is a table that is showing if I was opening a new trade right now, I would choose from one of the stocks in this list. 95, 98% of the trades we post of our own for the Blueprint, for the radioactive trading approach, Mike, come directly from this list. Of course, I can make changes to this list, if based on my portfolio and what I want to do. If I want to keep the risk to just below 8%, but I know my portfolio and that I typically won't be using stocks more than $90 or $85 per share, let's just go with 90, then I'll make those two subtle changes, but I'm leaving the time frame in to follow the rules that I want. I'm not going too deep in the money, but I am going slightly in the money for the single digit risk. Make my two little adjustments there. Go ahead and submit it. Okay, and that's what I was hoping for as well. So what I do is I'd go ahead and research and analyze these positions. How would I do that? I'm going to take a look at the stock chart. Company information if I don't know the position. Maybe some estimates, look at the profile if I don't know the stock, Mike. That's what I'm going to take a look at as well. And I'm going to take a look maybe at the profit and loss chart to run some basic what-if scenarios. This isn't all the positions that we're in. But that being said, if we navigate over to radioactivetrading.com and I'm logged into my account at radioactivetrading.com, and I go to the Opens, Trades, and Trade Tracker, this is where we post our open positions. And here's the one I opened on Monday, which is why I kind of laughed in that case, because I wanted to make sure that this was still there as well. So AIG, let's just take a quick view. AIG was opened at 62.01, and we purchased the August 65 put for 735, which gives us a controlled risk of 6.3% for, at the time, I think was 192 days out in time. The Fusion subscription at Radioactive Trading is where we post our open trades. Of course, every time we post a trade, we give a little description, why we decided to enter this trade. It was 190 days. what we were looking for, what we might do in the next couple days heading into a different event, or if our expectations were met. Were my expectations met on AIG? Yes, for 4 days. And then today happened. We all saw what happened in the last couple hours of today's expiration. So we got in here, of course, at 62.01 roughly, and we watched it go all the way up almost to 64, and it opened okay today. It was down a little bit, but it opened back up at 63 today. Not a huge move, but it was still going in the direction that we wanted. And then the market analysis and the market, I don't want to say panic, but the market blah that happened at the end of the day, Mike, that took this back down to a lower price. I'm still fine though. Trade's only 4 or 5 days old. Could I have sold a 65 call here when the stock was up at 63.50 or 63.60 and now maybe bought it back for zero? Yes. But one of the reasons I liked this position when I got into it was because there's the potential for earnings coming up, and it just did have a positive MACD cross. It just went back above the 20-day moving average. I liked what I was seeing from the bounce back here with earnings coming up. So what did I not want to do? I didn't want to cap the gain going into earnings sometime next week. That's not what I wanted. So I missed out on some premium, but that's okay. I still have other opportunities to adjust this position in the next few days, even though it's down in price, following the rules in the blueprint and the 12 different income methods. And see, if I got into AIG today, with the stock having moved down, pulled back that $1.48, I can get, instead of a 6.3 risk, it's a 7.7% risk in that case, Mike. But it would be the August 62.5 strike, which would still be a position I might consider at this time. However, as I mentioned, we only post the trades here. And the Fusion subscription also contains lessons which enhance the discussion in the blueprint, the basic married put search function as well, Mike, here at the Fusion subscription at Radioactive Trading. Very similar to what you just saw, but you can't adjust the criteria. And then there's members-only webinars, Fusion members-only webinars, and white papers as well. And of course, Blueprint owners have some additional members-only webinars and presentations and access to their updates on this site too. That's where the trades are posted. It's on the Fusion subscription of Radioactive Trading. All that being said, we do not treat this as an advisory service by any stretch of the imagination. I just want to be clear on that. I do not have a plan or promise Fusion subscribers that I'm going to open a trade every other Tuesday or every third Thursday. Yeah, we try to open 1 or 2 trades each month between the two of us, but when market conditions aren't right, why are there no positions that were opened in January? Simply because, well, I closed a couple, but the market conditions weren't right. We were waiting till we felt more of a bottom, and that's why I jumped into AIG. And I might be opening another position, probably in the $35 to $40 range next week for the Fusion subscribers as well. But this is more based on what we're doing on our actual accounts. And once I get to 5 positions or 6 positions, I'm probably not opening anymore because I've used up all the money, the allocation to those positions in that portion of my portfolio. So it's not an advisory service. This is more designed to help blueprint owners and investors interested in the radioactive trading approaches, how we use these approaches in our personal accounts, what we look for, how we would apply the income methods, and what to look for when we're applying an income method as well. So although the search results here are exactly where this trade came from on Monday, February 7th, it's now a different trade, but it's still on the same stock. These are just showing you the potential trades that we would be picking if we selected a trade today, based on the rules in the blueprint and how we like to take that approach. So again, the actual trades, income methods are only shown here on the Fusion subscription on Radioactive Trading, which is separate from the PowerOptions subscription. So Mike, I hope that answers your question about the search there and about the posted trades. And of course, you wanted more information about the married put approach. You can take a look at some of the Learning Center material here. The sketch, for example, you can access that free white paper, or check out the full course, the blueprint as well, for the full description of the proper structure, 12 different income methods, and much more, of course, is included. Great question from Walt. Walt says, the long collar is such a safe strategy. Why do you trade any other strategy with more risk? Well, it's because I'm young. I'm stupid. I need to have a little bit of danger, and I need to understand all the strategies as much as possible, Walt, for my job description. But you're dead on accurate. Here's the idea. When I first started working with Ernie, and back in, I can't remember, 2002, maybe 2003, 2004, somewhere in that time frame, I had a little bit amount of money, $2,200, $2,500, something along those lines. And we were linked with Options Express at that time. We had a broker linked to Options Express. We were partnered with them. They invited us to the Options Express Expo to speak and everything along those lines, Ernie and myself, as I got better, you know. And I was just trading covered calls. And the reason I was trading covered calls, Walt, is because that's all I was allowed to do. At that time, Options Express, with that amount of money, was just letting me do covered call positions. I couldn't get level 2 yet to buy calls and buy puts. So naturally, that's how I started. Many of our customers were doing covered calls at the time too. There were two groups out in Texas that were teaching two different ways to do covered calls, and one of them was also doing a covered calls and also diagonal calendar spreads at the time. And they were using our tools. They sent our customers to our tools because we were the only ones that had the most robust search for those kind of positions that they were looking for. And my experience with covered calls, Walt, amounted to exactly what everyone else's experience was. A good 4 or 5 months of, let's say, a 70, 80% success rate, making at that time around 2 to 2.5% return if assigned what I was right, and keeping the risks. You know, if I kept rolling down, eventually it came back up. So maybe I only take a loss of 4%, but I can manage it. 3 months later, I'm back up. And there's that one. There's just that one that drops 20%. And that just wiped out 10 previous positions over the last 3 months. And I'm trading with $2,500. So what does that mean? That means that I just wiped out 3 months of work with just doing covered call positions. Yes, I'm building the account as I'm going, adding more to the account. I'm moving up from trading $8 and $9 stocks, which worked out really well for me, by the way, in that time period when I was trading those lower price stocks. And so eventually I got the number of trades they wanted. I got the account size up a little bit, 5,800, not from trading. I was putting more money in when I had it. It's about a year later or so, it's about 6,000. Then they gave me level 2. And I hit, I'll be honest with you, the same frustration. I've been trying to make it work. I'm talking to Ernie, who's a master. I have his ear every day. I can talk to him every day. And I'm still just getting ahead, hitting singles. That's great. And then, oh man, hitting singles, 2%, 3%. Oh man, and so on and so forth. At that time, 2006, maybe it was around this time it was 2005, I think, when I started level 2, and I started playing with long calls, long puts. Never been successful with that. I'm going to be honest with you guys. I've never had a portion of my portfolio that's just buying calls or buying puts as an approach because I've never really been successful with it at all. Yeah, I've had a lucky hit here and there. I've had those. I've had 200, 300% returns once in a blue moon. I've had an earnings straddle that returned 285%. It was on Goose a few years ago when I think it went up from, I can't remember if it was 41 to 58 or if it went up from 58. I think it was 58 to 71. A really good trade. Once in a lifetimes. Haven't duplicated it. But now that I could buy calls, and I was struggling with the covered call. I'm sorry, now that I could buy puts, well, I'm sorry. And I'm struggling with the covered call. From that moment to about 2008 or 2009, the long collar, standard collar position, 25 to 30 days out in time, was 90% of my portfolio, and I loved it. Don't have as high probability as an in-the-money covered call, but you could still make a good return to the upside to 2.5%, 3%. If you're picking the right stocks, I had to change my criteria slightly and not risking more than 3, 4, 5% to the downside. Absolutely. That helps stack the market odds in your favor. And this was 75, 80% of my portfolio. So with the other 10, 15%, other than the money I was leaving aside for cash, Walt, for adjustments, I really liked the idea of diagonal calendar spreads. They were really intriguing to me. And once I got the next level approval, after a few collar trades, I started delving into those. I thought they were safer than the credit spreads, which they can be. And I wanted to be successful with the calendar spread. So I was trading calendar spreads, quote unquote, poor man's covered call, allowed me to expand into higher price stocks But I had to watch them, as you mentioned, more carefully because there's a chance of 100% loss in those positions as a leverage trade. There's the potential that my broker doesn't handle it right. I might look like I don't have a covered call option available, even though I have that leap call further out in time. I got to make sure that they see it's a linked position. That can cause other problems, especially in the account I was in. So yes, this was it. 2008. I have a coaching session with a gentleman out in Colorado. He asks me, can you show me how to set up your married put search where I can find positions that are 2 to 3 strikes in the money, but at least 160 days out in time? And I said to him, you know what? I can show you. The tool can do it. Let me show you how to adjust it. But I don't think you're going to make any money with this structure. I don't see how you're going to do it. You're paying way too much for the put. And he said, oh, really? Let me show you how I make money on this position. Of course, that man was Kurt Frankenberg, the original author of the Blueprint. He was a customer of PowerOptions. That's how we met him. He invited me to join as an attendee to one of his webinars, and I did. And then he invited Ernie, and then he invited me to join him to show the PowerOptions tools to help show what he was doing. That's how we got partnered up with Kurt Frankenberg, original author of the Blueprint, founder of Radioactive Trading, and we partnered up with him. And then I started to see something that made more sense. I converted half of my caller positions, Walt, into these married put structures. The difference is, instead of a standard caller where I'm looking to make, let's say 2.8% was my average on assigned and 3.1% was my average loss on a position. My win ratio was 71% at one point, but then it started to dip into, naturally, going into 2008, to about 68% on the position. Coming out of that, I started to notice that my success rate on callers, because of the further out of money, yes, sometimes I'd make 0.5% and I'd just rebracket the collar, Walt. Sometimes I'd make 1.5% and I might rebracket the collar or just close it. Sometimes it was 3%. But my success rate was never higher than 71%, 72%, I think was the highest I saw over a 12-month period. And the years that I was below 67, 68% success rate with this setup, I didn't have near the profit I was expecting. It was only 3, 4, or 5% because it was starting to eat up a little bit more. Actually, I'm sorry, this was 3.4. These are the numbers I remember talking to Kurt about. It's 2.8 and 3.4 for an extended period of time. Okay, now why is all of this important? The married put structure, if I pick the right stock for a 25 to 30 day out trade and the stock moves up 8%, on a standard collar, I make 2.8%. That's great. I love it. Hey, this 50% I say, Walt, that's involved in married puts and collars, a good portion of that, some portion of that is still in standard collar positions for regular 15, 20 day trade. The rest of it is in those 5 or 6 married puts we talked about in the Fusion subscription a little bit earlier on. But if I'm in a married put, the proper structure, in the first 30 days, the stock goes up 8%, I'm going to be sitting on a 4 to maybe 4.4% profit on the position. Not quite double, but higher. And I don't have to liquidate this yet. This put is still out 160, 170 days. I can move this up and lower the risk I had by half and still sell short-term calls against it to continue to increase that. Let's take a quick look. Am I still logged in? I think I am. All right. Since 2008, here we go. Oh, let me do this so that you guys can see the same thing. Since 2000, I'm not logged in right now, but since 2008, when I started posting my first positions, again, it was just 1 or 2 positions here. Average return on my win is 6.3%. Average loss is 5%. And I'm right 60% of the time. Okay. Ernie's, I'm sorry, folks, I needed a drink there. Ernie's is much higher. He's at 10.1% average on his winners. I'm sorry. Wow, Ernie. 11.2 on his winners, 5.2 on his losers. He's almost double me, but he's right 55% of the time. Why am I going all through this? One of the interesting and fun tools that we have available on Radioactive Trading under the Resources tab is called the Trade Simulator tool. What this tool does is allows you to put in your target return, the loss limit or target loss limit for a management technique, probability of loss, starting capital, and how much you'd invest in each trade. So let's say I'm doing a collar portfolio. My average return is a little bit to the high side of 2.8%. When I'm wrong, I lose on an average 3.4%. My probability of loss is 30%. I'm right 70% of the time. And let's say I start out with $10,000 and I just invest 50% each time. Right? Half of that into a trade each time, each cycle. Now, what this tool does is it flips a coin, Walt, 100 times. Heads, I win and make my 2.8% on the $5,000 I invested, or $140. Tails, I lose the 3.4%. And it's random each time, but it shows you your strings of winners and losers. So in this case, I'm right 68% of the time, almost a 50% gain, $10,000, took it up to $15,000, had a low drawdown, and an end return of $14,869. Let me just write that down. Now, let's put this at 35. So here, still respectable, 5% drawdown, 2.3% loss on the, I'm sorry, 23% profit on the position. Still good. But once you start to drop down to only a 59% success rate, you're 12%, you're still doing good, but you're not meeting your targets. This is the power of controlling risk. It really is. Now let's take a step back. What if I left my upside open a little bit more? And on my winning trades, I make 6.3%. I still control my losses to 5%. My probability of loss drops to 40. $10,000, 50% invested into each trade. Look at that. 65% success rate. By the strings of winners and losers, I was lucky enough not to see a drawdown at all. That's not realistic, but that's the strings of winners and losers. So many wins in a row right here, which is not realistic. But again, what is it? This is 65 and 35. This is triple what I started off with. This is higher than what I had with the collar with a similar protection in place. Let me get to 61. 24,000. I think when we were at 62%, we were at 14,000, 11,000. And again, luck of strings and winners. Let's get some losers off the bat. There we go. Still don't go negative. Let's get more losers off the bat. It's random each time, so I know this is annoying. There we go. 67% winners. It's up to here. I didn't have that with the collar structure, Walt. With making 2.8%, controlling risk to 3.4, and being right 67, this number was lower. Drawdown was about the same. But when I started walking, when Kurt wanted to know what I was doing and I walked through it, he was impressed of what we had developed. And we had actually published a small book, Protective Option Strategies, written by myself and Ernie Renner, on our approach for collars and the different type of collars there. Unfortunately, that book was released through Traders Library. I think it's still there on their website if it's still there. But that was released about 3 months before we did the rework of the blueprint and put it into the new format, and we started selling it with Kurt. So our emphasis was on selling that, not on the smaller book that was only $20. That's just business. But this is why. The upside higher, even though I'm taking slightly higher risk in this case, even being right, let's go to 60% again. See, look at that, 58 wins to 42 losses, and we said it was right 60%. I'm seeing a higher return with the married put structure on the ones that run, because I've left the upside open to start, than I was with the standard collar. Does it take me longer to get to 100 trades because I'm using a far out married put structure of 150 days? I might only have 5 or 6 positions open. Yes, that is absolutely correct. But again, the structure of the win-loss ratio and the benefits, if I was right 68, 69% of the time as I was with the collars, this would be extraordinarily successful. Now, you take that to the other side, and you take Ernie, who uses income methods a little bit more than I do. We take his numbers of 11.2 and 5.2, and you put his ratio at 45. That's the probability of loss, remember, Walt. So if I only have 45 wins, I mean, that's insane. starting off with $10,000 after 100 trades, only seeing a drawdown of 7% with a losing track record. Get up 59%. That's not where Ernie is. I know. There we go. Perfect. In theory, strings of winners and losers, this will outperform the married put approach. Yes, we'll use the income methods at times, but the married put approach with protecting the downside to the same single-digit risks that you might see on a collar, but leaving it longer term following the 3 core principles that are discussed in the blueprint. It's the only strategy I've seen where you can be wrong more often than right and still make money. And with the same win-loss percentage, the same success rate, Walt, I was seeing better performance in the married puts in my portfolio than I was seeing the previous years, and at the same time, side-by-side comparison with those standard collar approaches. That also depends on market conditions, do not get me wrong. But this is why I converted to the married put. Now, this is 40 to 50% of my portfolio. Why am I just not doing the 40 to 50% of my portfolio in standard collars and doing this? Well, there are some months I would agree with you on that. Absolutely, Walt. I don't have all the answers, but I've been very successful the last 5 or 6 years with the approach we've been doing with the bull put credit spreads, 88, 89, 87, 88% success rate, average 15% return on the winners, keeping the losses to under 50%, around 48, 49%. The market's going to change. The market is changing. That's not going to be the same success rate and the same returns I'm going to see in that strategy in the next 6 months or the next 12 months. But again, it's been very potent and very powerful. If it's not broke, don't fix it. Collars weren't broken. I could just use the married put as a capital intensive strategy in my position, and I was having the controlled risk I wanted with the higher upside that I wanted over time in those situations. So that's why I just don't do only the long collars, even though you're absolutely right. It is such a safe strategy with income coming in, but it does have a capped gain. And it's the second choice I do. A question comes in from time to time. And I'll wrap this up. I know you guys want to go. A question comes in from time to time. Mike, if there's any strategy that you could trade for the rest of your life, what would it be? And it would be the married put approach following the blueprint. Is it the highest return strategy percentage-wise that I trade in my portfolio? No, that's been the bull put credit spreads for the last 4.5, 5 years. No joke. I'm not going to lie about that. But it's not consistent. Okay, there are times when that part of my portfolio has been down 50%. That's why the bull puts only represent between 10 and 15% of my total portfolio, where this, also because it's capital intensive, is 50 to 60%. But when a person asks me that question, what is the only strategy you would trade if you'd only trade one strategy for the rest of your life? I say the married put approach. Why? Well, as we know, 7.5, 8 out of 10 times, the market wants to go up. We see hiccups here and there. We see downturns. We see corrections. But 8 out of 10, going all the way back to 1920, even before then, 7.5 to 8 out of 10 times, the market is going up. When you say to me, if there's one strategy you could only trade for the rest of your life, and you didn't ask that, well, I know, I'm just using this as an example. It's because what you're saying is that I'm somehow unable to do multiple strategies. I'm not at the computer where I can do adjustments and I can do other things. So in that situation, if in my portfolio, if I'm somehow incapacitated, I'm in a car accident and I'm in the hospital for months, or I'm in a coma or something along those lines, what I want for my family, for my kids, and for my wife is a position that's structured to take advantage what goes up 7.5, 8 out of 10 times, while having protection in place in case of the unexpected. That is why I answer that question that way. Because to me, that question is saying, if you were unable to do the adjustments that you need to do in a bull put credit spread 15, 20% of the time, you're unable to do rolling covered calls to keep yourself out of trouble or other things along those lines, that means I can't do the adjustments. So I wouldn't trade any other strategy other than this. If I had to be in a strategy and I was incapacitated and couldn't do adjustments, otherwise I'd just stay in cash. Well, I understand that. But that is why I picked this strategy. My second selection, if I could only trade one strategy for the rest of my life and have a set of criteria that would just move and pick the new trade for me and new trade for me, and it would be automatic, you're absolutely right. It would be the long collar. But this would be the first one. Long collar would be the second. There's nothing wrong with the strategy. It is such a safe strategy. You didn't need to hear it, but I gave it to you anyway. That's my history of trading options. That's how I got involved with the great Kurt Frankenberg and the Blueprint. That's why it represents 50 to 60% of my total portfolio. We walked through some of those sample numbers there on the resources tab, which showed you why. Great question, Walt. I hope I answered your question. Long collars are a favorite of mine and always will be. And the different combinations and different adjustments we can use on the long collars are fun as well. In a sense, I still am trading long collars because if I choose to, on that AIG position we mentioned earlier, where I have my August 65 put, if the stock comes back up to 63 and I sell a 65 or 67.5 straight call for some premium, I'm going to lower my risk. Yes, I'm going to cap my upside now. It's going to look more like a calendar spread because this is shorter term to March, and I've still got the protection out to August, instead of a standard collar that's just March to March. In different market conditions, the collar will outperform the married put. In most market conditions, same stock selected, the married put approach outperformed. Maybe not in the first 20 days, but if I kept doing it and doing it, the married put, starting with the upside open, allowing for the risk and the potential to bulletproof the trade and still get income, has performed better for me than the standard collars. The standard collars still perform better than me than covered calls. So that's why I still use the standard collars also, Walt. All right? Okay. Yeah, you're too old to risk my money. The married put collar strategy is best for me. I agree, and Ernie would say the same thing. I honestly think Ernie is an 80 to 85% of married puts. If he decides to go and cash a little bit, he still holds the married put positions. But yes, because he's in the same boat, he doesn't want to risk his money. He's a little bit older. I can still afford to take some chances, but when the market turns, and maybe in the next 5 or 6 years, I might scale back some of the other percentages I'm using in the calendar spreads. Sal says, never call it a poor man's covered call, because I never do. But those diagonal calendar spreads, the bull put credit spreads, I might start pulling back on those a little bit. Start putting more into the married puts and the growth stocks and the protection in place that I can use to manipulate. Because it's not like the standard collar where the put, I'm expecting it to go to zero to make max profit. Because I've got that put far out in time, it's not a wasting asset. It still holds most of its value for a longer period of time following the 3 core principles, as of course discussed in the blueprint as well.